Hello traders, Gary Wagner here just after 10 o'clock in Honolulu, 3 o'clock in New York on Friday. Happy Aloha Friday, as we say on the islands. It's the 8th day of May 2015, and this is the daily report for gold and silver, our weekend review. And we're going to end the week on an up note with precious metals trading moderately higher. Dow Jones Industrial, equities as a whole, a tremendous rally following a very, very favorable jobs report. First of all, the gold, 1187.30, up about $5 on the day. The low, 80.50. The high, 93 even. When we go over to the Forex, as you can see, trading at 88 and change. Highs and lows similar, 81.99 on the low and 93.80 on the high. Silver, also showing a substantial gain on the day, up about a full percent or 15 cents, 16.45, high 55, low 26. So traders, when we look at today's trading range, the week's trading range, and the overall trend of the market, it's been a difficult read to say the best. And the reason being, we're looking, first of all, at a 720-minute, half-a-day Japanese average chart. And there's no doubt we have had this market really caught within a defined range. We've got some extreme highs up here at about 23 in this area. These are, of course, highs that came in at around, I believe, 18. But the majority of the trading range, the vast majority of the trading range, really throughout the entire month of April as we go into May, has been really found between these particular marks. Now, the only thing that I can glean out of what we've seen lately is we have had these series of lower highs. We've also had these series of lower lows. So in essence, what we're looking at is a downward sloping channel, so to speak. And as you know, I have been under the belief that we've got to break out of what I call this muck or this sideways trading range. My sense is that we'll probably see it break to the downside, and that's based upon not only Elliott wave, Fibonacci, but also basic trend analysis. We've not been able to hold any of these recent highs. We have been coming and testing these lows, but we're still within this range. And as long as we remain really within this range, we want to see it either break below the recent lows, and we'll look at the bodies of these candles to call it right around 80, or above the recent highs, call it about 1210. 1203, important number. 1182, excuse me, also an important number. But short term, the best we can say about this market is we're still trading in a sideways trading range, but I do believe that we currently have a bias to the downside. So when we look at the longer term charts, this of course being a daily chart, it becomes quite evident what we've been looking at. This of course is the month of April and the month of March that we've got here. Call it the middle of March, after we had that one spike that comes in roughly 16th or 17th of March. We really went into this sideways trading pattern. And if you look at the longer term charts, it's actually fairly odd to see the market trading on this kind of a sideways trading range, but nonetheless, that is what we have. Now, on the chart that I've just pulled up, it's a daily chart in Japanese average format, but here you can really see the, I'll call it confusion or technical indicators that are actually agreeing with each other. And I draw your attention, we have Japanese average charts. When we look at the average chart, the first thing that becomes apparent is that we have alternating candle color, sideways. Absolutely tells us we've got a sideways market. Consider this, as the market's going down, you almost have an abundance or a consistent level of red candles, a little spike up, it goes green, then it goes back red. Here it goes green, red, green. You can see the same thing here, red and then green, aside from this one candle here. However, once we get into this area here, we get alternating candle colors. We have no clear-cut defined trend, and we're seeing this sideways market. Now, take that as we look at our MACD, for example, where we're looking for sells and buys, where the markets cross here, the markets cross here. This, of course, is what we call a false positive. In other words, it comes in but then breaks back below. And look at all the false positives you're getting right in this area, because you're really getting the market alternating back and forth. As you can see how it comes up right in here, it looks as though it's going to cross and then moves back down. So you're not getting a real clear signal in the MACD. And of course, when we look at the stochastics, you can see it's all over the board. We're not getting the kind of clear, concise signals or reads that we like to get. For example, in stochastics here, where you get a defined sell, or here when you get a defined buy in the market before it starts getting a little bit murky. And so when we look at these, the stochastics, the MACD, along with our just price movement, this being the Japanese average charts, we can see that this has not been the best environment for any kind of clear-cut trend to break out. If anything, what we're seeing is a sideways market. But that tells us another thing, and that is that as range tends to narrow, and let's go ahead and blow this or compress this a little bit, and we talked about this a little bit at the middle of this week. We looked at the fact that we've got these series of highs that are moving lower. So we've got a succession of lower highs. We've also got a succession of higher lows. And what does that spell? Well, to me, that spells compression triangle. And typically, when you get this type of tightening of range, what follows is a release of energy as you reach the apex, and you get a break to the upside or downside. Now, based on some of my studies, my sense is that we'll get that break to the downside. However, anything is absolutely possible. But right now, we've got to get some sort of clear defined trend, and we absolutely do not have that at this point. So when we look at our dollar, the U.S. dollar, how that traded this week and what we're looking at, it's clear. We've been, ever since we hit the stop at 100, we have had a defined and remarkable downtrend in the market, although over the last 2 trading days, right here and here, we have had the market kind of bounce off, with 94 being our level of support. Now, when we draw a line across, we can see that historically speaking, we talked about that this week, this area right in here really should provide a level of support on a technical basis, because this level right in here has been a point in which, as the market came up, it consolidated for some time before then spiking up to 100 here, where it found absolute resistance on 2 occasions. The question is, will it find support in this area? So when we look at the chart, though, from a weekly point of view, this, of course, is a weekly standard candlestick format. You can see these 2 tops here quite evident. You can also see this market coming down, but it did recoup a lot of the lows that we had at the beginning of the week. However, when we look at some of the technical indicators, you will see the following. First, when we look at our stochastics are telling us that the market is extremely, extremely overbought. Overbought comes anywhere above this 80 line on a stochastic. And simply looking at stochastics, what we're looking at is the current price in relationship to the highest highs and the lowest lows over n period of time, or whatever period of time we're looking at, one fast and one slower line, meaning we're changing the relative distance or number of days or weeks within the series itself. But you can see market absolutely comes up. You're getting a lot of crossing here, these false reads right in here, but it seems as though the bias continues to be to the downside. MACD, similar thing. We're not getting any kind of false positive, but look at how this market's begun to move down. We've gotten the hook that we look for, and the hook basically that we look for is when we have one line crossing over, and then you'll get something like that. So when we look at the MACD, that also looks like we'll see a continuation of the bearish sentiment that we have seen. And then lastly, I want to bring in another weekly chart, but this weekly chart is in Japanese average format. Hold on, let me get that. And traders, this chart, it is a weekly chart. This is the dollar index again. Couple of things that we're looking at. I have a simple moving average, and I have a fib retracement. So the key to the simple moving average, it's a 14 cycle, so 14 weeks. I'm looking at a shorter term moving average. Quite simple to see when it's sidelined or when it's alternating or a flat market. You can see it's above and below these moving averages. No real clear-cut signal. You get this break right here, and this is where we have a runaway market. The market is actually widening above this moving average. You can see it moving farther and farther away. Here it starts to come close. But if you look at the trading activity that we got this week in the market, this is the first time we've actually broken below that moving average, the 14-day moving average. And that tells us on this technical study that we'll probably see lower pricing ahead in the dollar. Also, where could it go? Well, we know that we've got support at 94. We've seen that on our technical basis. But in terms of pure Fibonacci numbers, you want to look at the 38% retracement level, and that's at 92,097. So just say 92. If in fact this market continues to retrace, in other words, we had this spike up, correction, it would not surprise me at all to see the market move as low as just above 92 based upon this study. Lastly, I do want to take a look at silver. Silver today up substantially, up over 1%, about 17 cents it looks like we have seen in terms of the close on the day. But interestingly enough, we talked about the basic channel that we saw. Even though the market's been sideways, we talked about the basic channel. But if you notice on silver, our basic channel or our bias, rather than to the downside actually, has been basically to the upside. This is how we'd look at this channel. In other words, it is sideways. There's no doubt about it. But it looks like the bias on this is actually to the upside. Now, another technical study which backs us on this is our moving average convergence divergence, our MACD. And here you can see they've crossed back to the upside. And when we look at that, let's go ahead and blow that up. We can see real clearly how we've gotten that cross, and now what we look for in the MACD is we want to see in particular a widening of our two lines, because a widening such as you're getting right here would really indicate that you're getting some strength into the market, and we could in fact see some higher pricing ahead. So unlike some of the other markets in the precious metals that I'm looking at, I'm actually starting to get a favorable bias towards silver. This has been Gary Wagner wishing you as always good trading. We'll talk to you on Monday for another daily update and review. Have a great weekend. Bye-bye.